Hello. In this video, we'll be going through some special issues in revenue recognitions about variable consideration. Companies recognize revenue when the goods or services are transferred to customers for the amount that the company expects to receive in exchange for those goods and services. And there are 5 steps used to apply that principle. Number 1 is identifying the contract. Number 2 is identify the performance obligation that has to be satisfied. Number 3 is determine the transaction price and then how to allocate that. And number 5 is when do we recognize that revenue? There's some special situations when it comes to determining the transaction price. If I go to Starbucks, buy a cup of coffee for $5, it's very easy to determine the transaction price, but that's not always the case. There are often times with contracts there are variable considerations, which means that a portion of the transaction depends on the outcome of future events. And think of a construction might have incentive payments. We're going to pay you X dollars, but if you finish, within 8 weeks, we'll get you an extra, $50,000. And if you finish within 10 weeks, we'll get you an extra $25,000. And things like that. Or with music, royalties are very common. For every time your song is played on the radio or Spotify or whatever, you're going to get 5 cents. So the outcome of how much money you're going to earn is not necessarily fixed. It just depends on some future events. Other examples are in healthcare when hospitals or when insurance companies pay out their Medicare, Medicaid reimbursements, the hospitals don't necessarily know how much they're going to get. Manufacturing, a manufacturer could sell products to its seller, right? And if they sell a certain amount, then they might get a 2% volume discount on that amount. So there's various ways that a transaction price is not necessarily fixed. The question arises then, what is the transaction price? How much revenue do we need to recognize when we make a sale? And there's 2 ways to make that estimate. The first one is the expected value method, and that is when there are several possible outcomes. Like in my construction example, there were several possible outcomes. If you have a contract where if you get $100,000 for this contract. However, if you finish it, within 10 weeks, I'll give you an extra $50,000. If you finish it within 12 weeks, I'll give you an extra $25,000. And if you finish within 14 weeks, you get nothing extra above the initial $100,000. Those are several possible outcomes. The other way to estimate the transaction price is the most likely amount, where there's really only 2 possible outcomes. So either it happens or it doesn't. And we're going to go through examples to demonstrate each of those methods. TrueTech enters into a contract with Pro Sports Gaming to add Pro Sports online games to the TriNet network. Pro Sports offers popular games like Brawl of Bands and wants those games offered on the TriNet so Pro Sports can sell gems, weapons, health potions, and other game features that allow players to advance more quickly in a game. The terms of the contracts are that on January 1, 2027, Pro Sports pays TrueTech an upfront fixed fee of $300,000 for 6 months of featured access. So they're going to get the $300,000 no matter what. Pro Sports will also pay TrueTech a bonus of $180,000 if TriNet users access Pro Sport games for at least 15,000 hours during a 6-month period. So this first bullet point is fixed, and the second bullet point is variable. Depends if those games are accessed for 15,000 hours. TrueTech estimates a 75% chance that it will achieve the usage target and receive the $180,000 bonus. Let's go through the first way to estimate this, and this is the expected value. And the way you do the expected value is you calculate as the sum of each possible amount multiplied by its probability. First, the possible amount is $300,000 of fixed fees, so the probability of that is 100%, right? So this is the amount that we're going to record on day one because it is fixed. We are for sure going to get that money, and so we're going to record that. The $180,000, there's a 75% chance that we'll be able to meet that 15,000 hour criteria and receive that bonus. So we're going to take the $180,000 bonus times 75%, and that expected outcome is $135,000. So the expected value of the contract price at inception is that $300,000 plus $135,000 added together is $435,000. So on day one, on January 1, 2027, we're gonna receive cash for $300,000 from Pro Sports, and we're gonna record deferred revenue for $300,000. We haven't earned that revenue because our performance obligations have not yet been satisfied. They will be satisfied as we allow the Pro Sports games to be offered on our TriNet network. Now, alternative number 2 is the most likely amount. And again, the $300,000 is fixed. And when you do the most likely amount, you say either you're going to get it or you're not. So in this situation, the $180,000 bonus is, the expectation was that there was a 75% chance that TrueTech will achieve the usage target and receive that bonus. So if it's the most likely outcome. So we're going to say, oh, then we think we're going to recognize the full $180,000 bonus. But again, on day one, on 1/1/27, we only record the $300,000 that is fixed. We're going to go through how to recognize this $180,000 in the next few slides. So when we look at the most likely outcome, which is the full $180,000 of bonus we expect to receive, at the end of each of the 6 months, this is what we're going to record. We are going to debit deferred revenue for $50,000 each month. On 1/1/27, right here, we credited deferred revenue for the $300,000. We received that cash. And so when we divide that by 6, we get $50,000. So we're going to debit that account by $50,000 for the next 6 months. And additionally, we're going to debit bonus receivable for $30,000. And the way we get the $30,000 is we get the full bonus amount that we think we're going to receive, which is the full $180,000, and divide by 6 months is $30,000. So each month, at the end of each month, we're going to debit bonus receivable for $30,000. And then we're going to recognize the service revenue for the fixed fee amount and the bonus amount, which is the 30 plus 50. So at the end of each month, we're going to credit service revenue for $80,000. At the end of the 6 months, for deferred revenue, our liability is 0 because we credited $300,000 on January 1 and debited $50,000 for the next 6 months. So our liability at the end of the 6 months is 0, which is what it should be. I'm going to skip over here to service revenue. We're going to recognize $480,000 of service revenue at the end of the 6 months. And if I go back to my previous slide, right here, that's what we said the expected value of the contract will be, is the $480,000. So I would expect to have $480,000 of service revenue at the end of the 6 months. Now, this at the end of 6 months, assuming we do meet that, assuming we do meet that criteria and we receive that bonus, we're going to receive an extra $180,000 from Pro Sports, and then we're going to credit our bonus receivable for the $180,000, right? So our bonus receivable is 0, our deferred revenue is 0, and our service revenue that we've recognized throughout the 6 months is $480,000. So that's if we actually receive it. What happens if we don't get if we don't achieve that usage target of 15,000 hours. But we have credited, debited bonus receivable for $180,000, and we've recognized service revenue for that $180,000 over the 6-month period. Well, we still have to get rid of our bonus receivable because it shouldn't be there. So we're still going to credit bonus receivable, but now what's going to happen is if we don't do anything, we'll have recognized $480,000 of service revenue, but we shouldn't. We should only recognize $300 because we're not actually going to get that $180,000. So we have to debit the service revenue for the $180,000, which is what we see in the journal entry, and then the total service revenue we'll recognize for the 6 month will be only the $300,000. Now assume that after 3 months, TrueTech concludes that due to low usage of pro sports games, the most likely outcome is that it will not receive the $180,000 bonus. So this is for months 1 through 3. We were assuming that we will get it. So we were recognizing the $30,000 per month of bonus receivable and service revenue. And then at the end of the 3rd month, we realized, no, we're not going to meet that 15,000 hour usage target. And so we need to reverse what we've booked for the first 3 months. So at the start of April, we're going to be crediting our bonus receivable that we have debited to date, because we debited bonus receivable for $30,000 for the first 3 months. So we have to get rid of that because we're not going to receive that $108,000 bonus. So we're going to credit the bonus receivable. And then our service revenue, right, the first 3 months, we've recognized service revenue of $80,000 at the end of each month. And that $80,000 is made up of the $50,000 from the deferred revenue from the fixed fee plus $30,000 from the bonus. So we have to reverse $30,000 for each of the 3 months, which is how we get a debit to service revenue for $90,000. So then if we continue the next 3 months, we'll just do the $50,000 recognition here in this slide. You can see it better of each month. For months 4, 5, and 6, we're going to continue debiting our deferred revenue by $50,000, but now we're only going to recognize service revenue for $50,000. We're not going to recognize that additional $30,000 for the bonus in the last 3 months because we know we're not going to get it. Let's go through a concept check. CD enters into a contract offering a variable consideration. The contract pays Citi $2,000 a month for 6 months of continuous consulting services. In addition, there's a 60% chance the contract will pay an additional $4,000 and a 40% chance the contract will pay an additional $6,000, depending on the outcome of the consulting contract. Citi concludes that this contract qualifies for revenue recognition over time. So what would Citi recognize for the first month of the contract using the expected value estimated method? For the expected value, we're going to calculate the sum of each possible amount multiplied by its probability. So first, I have a fixed amount because we know that the contract is $2,000 a month for 6 months. So I have $2,000 a month for 6 months, so that equals $12,000. That's fixed. We know that's not going to change. Then it tells us there's a 60% chance the contract will pay $4,000. So here's my variable. The $4,000, there's a 60% chance it's going to pay $4,000. So that's $2,400. And then there's a 40% chance they'll get an additional $6,000. So this is dollars. So $6,000, there's a 40% chance we'll get that, and that's also $2,400. Okay, so these are the variable options. And so what I'm going to do is I'm going to take all those totals and I'm going to sum them up, and I get $16,800. Right? That is going to be my total anticipated value of this contract, but that's for 6 months. So I'm going to divide that by 6 months. So the amount of revenue that CT would recognize for the first month is going to be $2,800 per month. Okay, that's using the expected value. Let's use the same exact facts, but now we have to calculate the amount of revenue CD would recognize using the most likely amount. Well, we still have a fixed amount with $2,000 times 6 months, right? So that's $12,000. That amount is fixed. Now, our variable amount is going to be our most likely amount. And we're told that there's a 60% chance that we'll get $4,000 and 40% chance to get $6,000. Well, 60% chance is the higher percentage, so we're going to use that one. That's the one we're going to assume that we're going to actually meet. So we're going to say that is $4,000, right? 60% chance that we'll get an additional $4,000. And so we just say the full $4,000. We think because that's the higher percentage, that's the most likely, we're going to recognize that as the anticipated value of the contract at 100%. So our total anticipated value is $16,000 for this contract. We divide that by 6 months, and that gives us $2,667 per month of revenue that we will recognize for this contract.